Equities are a growth asset class, and there is nothing better than seeing growth equities delivering a near nine bagger over the past 20 years, and more importantly, outperforming their poor value cousins by an annualized 600 basis points. For long term investors, the prognosis is clear: stay with growth, stay with quality. There are, however, periods when value does better. And to be clear, when we talk about value, we aren't referring to cheap stocks. We're firm believers in you get what you pay for principle. Value sectors, typically cyclicals, tend to do better when growth takes a breather and uncertainty rises. Late 2018, the pandemic, 2022, and the first quarter of this year are some periods when growth faltered as uncertainty, whether economic or policy, rose. That's when value performed. Are we seeing a similar setup now? It certainly looks that way. Financials, materials, and energy are all having a moment relative to the broader market and certainly relative to tech. Just this year alone, from Liberation Day lows in early April, value has underperformed between 17 to 20 percentage points, but this is now reversing. As the world prepares for the Fed to resume rate cuts later this month, it would be in response to jobs weakness, the precursor to growth risks. A steeper yield curve also helps banks. As for materials, they tend to do better in periods of inflation, and there are definitely supply side risks, albeit moderate at this stage. The case for energy is perplexing though. The divergence between oil prices and oil stocks does bear watching and a setup for a long short trade. Zooming out, the value revival relative to growth appears to be in early stages and is in sync with potential economic weakness. Financials appear best placed. This is Sunil Garg from Lighthouse Canton.